Welcome back to our pre-budget economy series, the growth deficit balance. We have been speaking with Ashima Goyal of the PMEAC, Samiran Chakraborty of Citi, Sajid Chenoy of JPM and Deepali Bhargava of Credit Suisse. Well, we've discussed what can be the nominal GDP growth that the government can assume reasonably and what tax revenues it can assume. Now let's come to the expenditure numbers. Samiran, what would be your assumption in terms of expenditure growth?
So at a very broad philosophical level, we have taken a call that this is too early for the government to turn populist in this year's budget. So that's why we are expecting that the expenditure growth number would be a tad lower than the nominal GDP growth number. Yes, there are a bit of risks around how much of oil subsidy increase they will have to budget for, and to what extent there would have to be more money allocated for rural and infra. But even with reasonable assumptions, we think that it's possible to get around 10.5% of expenditure growth for next year, which should be okay given that growth is already picking up and we don't really require a large dose of fiscal stimulus at this moment.
What's your deficit number expectation, both percentage and aggregate?
So we are getting into about 23 plus only on total expenditure, 23 trillion plus. So that should give us a fiscal deficit of about 3.2% of GDP for next year, vis-a-vis 3.5% for this year.
Okay. Deepali, what would be your expenditure number and more importantly, the two deficit numbers, percentage and aggregate?
Right. So, Lata, we're working with 3.4% of GDP for this year and 3.2% for next year. So for next year, if you look at it, receipts are going to be higher by about 0.4% of GDP. I think the government will partly use this space to cut down on deficit and partly to increase expenditure. So in our numbers, we have a 3% slip in expenditure for this year, and which gives you a 13% year-on-year growth for next year, which roughly gets to about 23.5 trillion worth of overall spending next year.
Fair enough. What would be the corresponding numbers for you, Sajid, the expenditure growth and deficit numbers?
So my sense is next year you will see higher expenditure, more than nominal GDP. So on a base of 12% nominal GDP, I would expect expenditure growth to be more than 13 to 14%. I think in particular there'll be much more capital expenditures because this year, given the actual outturn last year, capex budgeted is only going to grow at 6.7%, and they'll be cutting some of it in the next few months. So the actual growth rate this year could be closer to 5%. On that base, I think the government will be very keen to boost capex. So our sense is, as a percent of GDP, expenditure goes up by between 0.1 and 0.2. I think the key is going to be how you budget subsidies, because if you have much higher expenditures but you haven't fully allocated for subsidies with oil prices at 70, that could be a problem later in the year. Our deficit number this year is 3.4%. Next year it's going to be 3.2.
Ashima, to come to you, and you know, we've always struggled to get to 2% of GDP as our capex expenditure. Every year we fall short and get to 1.8 or 1.9, and looks like that will be the trend in FY18 as well. What will qualify as a good budget for you in terms of expenditure quality?
Yeah, as I said, infrastructure expenditure is important, but there also you can leverage on expected rise, and you know, through this EPC they're doing some of this, so you can spend more, and you can leverage private expenditures also, so you can give a bigger impulse to infrastructure spending. And that is also a good thing to do because non-tradable goods expenditure creates more internal demand, as well as removes bottlenecks.
And 3.2 is healthy, you will think, because actually 3.2 is not achieving the target of 3. Okay for you, Ashima?
No, I think that there's been some miscommunication here because this markets expect that path and therefore 3%. I think the communication should be that given our expected growth and the sort of comfort we have in terms of the relative, you know, our growth rates are much higher than real interest rates. So we can achieve very healthy debt levels even with wider deficits.
Okay.
And I think that communication should go to markets.
Oh, I don't think the markets will be very happy with that.
Announced that.
I'm not very sure. In fact, that is my final set of questions. Samiran, will 3.2 be taken in a benign manner by the bond markets? And on the contrary, I mean, in contradistinction to what Ashima is saying, will it be better for the bond markets if the government accepted the encasing report in some fashion and actually gave a glide path?
So 3 points, Lata. First is that on a very broad sense, any fiscal deficit reduction, the glide path being followed is good news for bond markets. Second is any acceptance of the encasing committee report, particularly with respect to fiscal council, etc., should be taken positively also. But I think the bigger problem is the gross borrowing estimate that will come out of this fiscal deficit number. So 3.2% of GDP fiscal deficit can also lead to significantly wide variation in estimates of how much will be the net borrowing number and gross borrowing number, because you'll have to add the buybacks, the switches, and how much will be from small savings. If you recall, last year they had budgeted for 1 trillion rupees of small savings. For the first 8 months, we have got only about 55,000 crores. So based on all that, we have to look at the bond market impact, because a large gross borrowing number today, where the market is really looking for the incremental buyer, could be a bit of a concern. The bigger challenge in my mind today is who is going to be the incremental buyer rather than what is going to be the incremental supply.
Okay. Well, actually, I'm just looking for the exact net and gross borrowing number. Would you have one, Dipali?
Yeah, so for the centre, we're looking at a net borrowing of about 4.7. I think about 2 trillion worth of redemption. So the numbers should be close to 6.7, 6.8 on a gross level. But Lata, I wanted to highlight 2 points on the net borrowing and the demand supply debate, which is really net borrowing is what really hits the market is centre plus state. So if you look at both of them put together, I think we are pleasantly surprised by what's going on the state finances part. So as a percent of GDP, your state plus centre net should be lower this year, and we're factoring in for a lower number next year as well. So there is higher comfort with state finances, which is positive for the bond market. And secondly, from the demand supply perspective as well, with higher deposit growth next year, RBI likely being a net buyer than a net seller, and small savings, although obviously with a bit of correction next year as more allocation is happening towards equity, we're still expecting small savings to be more robust. So I think from a demand supply perspective, we will probably see a better balance than next year than what we saw this year. So we think that probably there is still scope for bond yields to consolidate overall.
Sajid, final 2 numbers from you. What is your net and gross number?
So we're in the same ballpark. Our net number is, close to between 4.6 and 4.8 trillion. The gross number is closer to 6.5 trillion. But I think the larger point here is how, adding the point that was made by Dipali about centre and states. State borrowing is still 15% higher this year. So as a percent of GDP will still be greater. And total issuance this year, centre, state and RBI, the fact that they did sales versus OMO purchases was 50% higher than last year. So the key is going to be, given currency in circulation, but also given the fact, Lata, that we still have a large BOP surplus. So if to the extent that the RBI is intervening in the FX market and creating base money, that at some point will counter the fact that currency in circulation is picking up. So I think ultimately, Shamiran's point is the right one. Issuance could change by 30, 40, 50,000 crore. Where is the incremental demand going to come from? Given that foreigner limits are full, the RBI may be forced to sell at some point next year, and banks are already holding much more than they desired to, and with deposit growth weak, the marginal propensity to buy by banks is very low. So I worry about the dynamics in the bond market going forward. That in turn pushes up corporate bond yields, as we've discussed before.
All right, that's a lot of numbers all of you have put on the table. Thank you very much for joining me. The key things that our experts believe will make for a good budget is deficit should be 3.2% or below. The tax growth assumption can be between 13 to 17% as well, and they would still consider it a good budget. That gives the government a lot of leeway. But the borrowing number, that will be important. If the borrowing number is too big, anything more than that 4.5 lakh crore, the bond markets would worry. Thank you very much for joining me in the final edition of our pre-budget economy series, The Growth Deficit Balance.